Good afternoon, everyone, and welcome to today's webinar, The Fundamentals of Indirect Rates with Robert Jones of Left Brain Professionals. My name is Liz Brigson. I'll be your host for today. We'll review our housekeeping items briefly, and then we'll go ahead and get started. So first of all, to get the most out of the presentation today, you'll want to utilize the GoToWebinar questions panes for live interaction. And if you've had a chance to join us before, you probably know exactly where that is. And yes, Lyle says hello from Texas. You can go ahead on out there. Let us know where you're joining from and if you've had a chance to join us before. It also lets us know that you found the questions box and you can use it for questions and feedback as we go throughout the presentation today. Also, I'd like to direct your attention to the handouts. You can download the handouts from the presentation today, both from the GoToWebinar control panel and also from your in-course dashboard. So we know you'll want to add these handouts to your future reference materials and resource materials that you probably keep on file, because Robert has a lot of great information to cover today. This is a 1-hour webinar. There will be 4 polling questions for those of you who are interested in earning CPE credit. You'll want to answer at least 3 of those 4 questions. And if you do qualify, your certificate will be available for you to download from your in-course dashboard an hour after the conclusion of the event today. If you have any questions at all, feel free to email us at support@incoursa.com. We're on LinkedIn, and I'm also on LinkedIn. I would love to connect with you. All right, it is my pleasure to welcome back Robert Jones with Left Brain Professionals. We really appreciate Robert for his desire to provide education in the government contract accounting space. Robert has a really fantastic background to be here presenting on these topics today. So first of all, he has had quite a few roles within business management, compliance, and operations. He's been a controller. He's walked in the shoes that many of you probably wear today. He's managed hundreds of millions of dollars of defense contracts. And now as an instructor and speaker, he really brings that background, that knowledge to teach other professionals the best way to handle and manage government contracts. So with that, Robert, great to welcome you back today. I know you have a great presentation in store for us, so I'll pass things over to you.
All right, well, thank you. We appreciate the opportunity to be back here. Yeah, again, my name is Robert Jones. Our firm is Left Brain Professionals. Just a couple of seconds to chat about us. We are a boutique accounting firm serving only government contractors, and we practice primarily accounting system design, implementation, and audit support. My colleague, Melissa Metzger there on the screen, she's unable to join us today, but she may be with us on some future webinars. Again, we do a lot of work around helping clients select the appropriate accounting system, whether software-oriented, fixing policies, procedures, guiding them through DCAA, DCMA audits, training, and then the related cybersecurity. Obviously, as we're dealing with people's software, hardware networks. We talk about cloud computing for accounting practices. We have to be cognizant and compliant with the various cybersecurity requirements. All right, we've got a lot of information to get through today here in an hour, so I'm probably going to whiz through parts of it because I want to get to some really key stuff near the end of the presentation. I always say that if I do my job and do it well at the end of this presentation, we'll have achieved these learning objectives, and that is you'll be able to list the 5 basic cost pools, describe the composition of each of those cost pools, identify acceptable allocation bases and methods, execute the proper calculation, and that's one of the things I want to get to because the math in this really is fascinating to me. I guess that maybe that makes me a nerd. And then list tips for full cost recovery, and we'll talk about what full cost recovery means. All right, so 5 basic cost pools that we're going to talk about today when we talk about the fundamentals of indirect rates. We'll talk about direct, or otherwise known as cost of goods sold, or COGS, the fringe pool, overhead, G&A, and unallowable. So with that, let's dive into direct. Again, I said that in the commercial world, people refer to this as cost of goods sold, or COGS. When we're talking about government contracts, terminology we use is typically direct. These are costs that are directly attributable to a final cost objective. And that phrase there, that terminology is key. That's what you'll find in the government regulations. And what is a final cost objective? That is a contract or a job, or whether you call it a job or a project in your system, a product or a service. And then what are the things that make up direct costs? So labor, materials, travel, ODCs, and subcontractors. And again, here we're talking about costs that I can assign specifically to a particular contract, client job, or a specific product. The next pool that we talk about is fringe. And I always describe this as the cost of maintaining W-2 employees. I always like to bold and highlight there the W-2 aspect, because when we talk about fringe and you look at the type of expenses that are listed here, these are the expenses to maintain our employees, right? So health insurance, employer taxes, retirement, paid absences. These are the expenses that we incur on behalf of our employees. We do not pay these expenses for our subcontractors or for our temporary labor, right? Those other companies take care of those expenses. While yes, we pay them indirectly in the billing rate that they charge us, they're the ones responsible for them. So we don't separately account for them in our fringe pool. And that's really important when we get to the portion of the seminar today. When we talk about the allocation method, you'll see that the base of the fringe pool is going to be all of our labor. And we're going to specifically exclude that subcontractor labor or temporary labor. The other thing to point out here, and probably need to mark it a little differently on the slide, is the maintaining aspect of employees. So this is not hiring costs. So hiring costs fall elsewhere in our cost pools, and I'll give you an idea where that is in a moment. Again, this is the maintaining portion. All right, the next slide, we're going to talk about overhead, and actually the next two here, we're going to talk about overhead and G&A. I like to talk about them a little bit together, so I'll kind of explain them separately and together and try to clarify the distinctions between them. This is usually one of the common questions I get from somebody who's not used to thinking about them being separate. Somebody will say, well, what's the difference between overhead or G&A? And I think part of that, again, stems from a lot of the commercial world where companies generally just say, I've got, cost of goods sold, and then I've got overhead. And so they don't have a concept of taking all of those indirect expenses that become part of overhead and separating them into separate pools. Some companies will refer to that as SG&A, sales, general, and administrative expenses. They might break out SG&A separate from overhead. Many do not. Again, they may just have a single overhead. But when we're in the government contract space, we do talk about indirect costs or indirect expenses as a whole, but then we break those down into very specific pools, primarily, again, fringe, overhead, and G&A. So overhead are the costs of supporting customers, products, or services. These are expenses that are not directly attributable to an end cost objective, right? So even though I say that I'm supporting customers, products, or services, these are situations where I'm incurring those costs, but that cost may be supporting multiple projects or multiple customers or multiple contracts. And I can't say that, this portion goes to that particular job. It's also could be a situation where the cost of even trying to, the administrative burden and cost of trying to allocate those costs wouldn't make sense, right? So let's say, maybe somebody did work that supported multiple projects. Would you take the cost of their work and break it down to the minute level and allocate that out? Well, that would be a lot of, that'd be a lot of overhead on top of overhead, right? Trying to figure that out. And so we just lump it into a pool and we allocate it out. So what types of expenses are in overhead? General support. So it could be a help desk, could be a helpline kind of thing. Again, maybe basic product updates. If you're selling software, it can be those patches that you provide, if you're selling software. Things like idle time. And to clarify what I mean by idle time, my favorite example that I like to use is having a manufacturing floor. Friday afternoon, and maybe it's we got to noon, everybody had lunch, there's not really any direct work left to be done, or maybe we're waiting on some materials or something. And so I take part of the crew and I say, okay, this part of the crew, you're going to clean out the tool crib and you're going to reorganize the stock room today and get things cleaned up. Maybe we're going to scrub the floors or whatever the case may be. Right, so I'm taking those employees who are otherwise direct and I'm putting them to do indirect kind of things, right? Because that type of work of cleaning and organizing doesn't benefit any particular job. So that time now needs to go into overhead, and we refer to it as idle time. Things like training for our employees, right? A lot of our employees, we should be providing some kind of training, whether it's training on our internal policies and procedures, if they have to have certifications, maybe it's a weld certification or something like that, right? We have to provide that training and certification to them. Those expenses become overhead. Manufacturing or service supplies, again, in an electrical environment, some of our clients that we have do electrical, high-end electronics, I should say. So things like solder and specialty wipes that they have to use, things that they use in that kind of environment, become part of those manufacturing supplies. And then our cost of facilities. Now, in a future webinar, we're going to talk about advanced indirect rates and cost pools, and we'll actually look at a situation where a company may break facilities out separately. Put that on the back burner and save that thought for another day. For argument's sake here today, and what many small companies do with a simplistic approach to indirect rates is that they take the facilities and simply include that into their overhead pool. So that's overhead. Let's chat for a moment about G&A, or general and administrative. And I'm going to flip back and forth between slides a couple of times here. So overhead, just as a quick reminder, was the cost of supporting customers' products or services. And when we talk about G&A, we're talking about the cost of operating the business, or what I also say are the costs incurred regardless of the number of customers that you have. So things like accounting, business development, HR. Remember a couple of slides back when we were talking about fringe, I said that fringe was the cost of maintaining employees, but the cost of hiring employees would fall into general and administrative. And then the other item here on the slide is IT, or information technology. And if you step back and look at those, I think we would all agree that those kinds of expenses, right, are the kinds of things that do support the entire business, and they support everybody in the business. The last pool for this section today is the unallowable. Again, we're going to teach a whole webinar on this in the future, so I hope you'll stay with us in this series. Today is number 2 in a series of 12. We will have a special webinar on unallowable costs. We'll dive deeper. Today, suffice to say that unallowable costs are those costs that are not allowed either per the terms of the contract or per regulations, and primarily we're talking here about FAR 31, or the Federal Acquisition Regulations, Chapter 31 here. Now, there are other cost pools. These are the primary ones. Again, today's topic is fundamentals of indirect rates. If you'll come back for the next webinar, we will be talking about the advanced indirect rates, and we'll build upon what we've discussed today. With that, Liz, I'd like to go ahead and kick off the first room poll, please.
All right, sounds great. So first poll, which of the following is not one of the basic cost pools? So we'll go ahead and leave this open for about 30 seconds or so. Now, we had a question come in right when we started the conversation about allocation bases and cost pools. So I think you've answered this already, but just for a quick recap, when you're looking at fringes, is your allocation base direct labor or total labor?
So typically with fringe, we allocate that over all labor, right? Because all of our employees are benefiting from that. And you'll see that on an upcoming slide where we will actually pull in the direct labor, overhead labor, and G&A labor as the base of fringe.
Okay, wonderful. We'll go ahead and close this poll down. And we'll take a quick look at the results because they're a little bit mixed here. So which of the following is not one of the basic cost pools? So can you let us know who's right here?
So the correct answer is B, assets, right? So we know that assets are a group of accounts, but here we're talking about the cost pools that we've discussed today. And we did talk about already overhead, fringe, and unallowable. So if you selected
Very
one
good.
of those, yeah, that would have been an incorrect answer.
One way to look at that might be their income statement accounts, right? Not balance sheet accounts.
Correct. In this situation, yes. All right. We'll go ahead and move on to the allocation methods here. So the first pool that we're going to talk about is direct. So it's important to note that the direct, while we call it a pool and the way we work with it and the way we segregate it and create reports around it, those costs are not allocated, but they are simply assigned to their proper cost objective, right? So we don't take those costs and we don't take the direct pool as a numerator and try to define a base in the denominator and come up with a rate. That is not what we do with direct. Direct costs, so let's say, for example, I've got 3 projects going on and I order material to work on project 2. I know at the time that I'm ordering that's for project 2, so I code it for that. So when the invoice comes in, it goes straight to that job cost report in my accounting system. Fringe, and this goes to the question that somebody brought up. And what I do want to mention, particularly with today's webinar, is I'm going to talk about the most typical way. We will show some other ways that people do allocate, and so there are options out there. I will say that there's generally no right or wrong way to allocate these costs, as long as you're using one of the acceptable methods for that particular type of cost. Where people get into trouble usually is that the composition of the pool or the composition of the base is incorrect, right? So they pulled the incorrect GL accounts into those pools, into the pool or the base, or they have sometimes just selected a completely incorrect type of allocation method. Here, when we talk about fringe, the 2 primary approaches are either over total labor dollars, which is what we believe to be the most recommended and most common. We feel like it's the most fair with the least variances in comparison to doing total labor hours. It's least common, and there's a higher risk of over or under absorption of costs. And without diving too deep into the math here, if you think about a situation where you have a lot of salaried or exempt employees, those labor dollars are going to remain fairly stable. But in a world where you have direct employees who are salaried, again, or exempt, if the amount of direct hours that they're working fluctuates significantly over time, you could see where those fluctuations in the number of hours could cause problems from an absorption perspective, whereas the total labor dollars would otherwise remain fairly stable. And that's the reason that we primarily do total labor dollars. And it's also important to note here that, again, back to the question that somebody asked before, it is total labor dollars. So that would include my direct labor, my G&A labor, and my overhead labor. Other possible methods for allocating fringe. So in some industries, and maybe the person who asked the question, because I think they said, well, what about direct labor dollars? There are some industries where they allocate fringe only over direct labor. The architect or the AE industry is one of those. We don't like that so much because we don't feel that it's quite as fair and accurate. It's not really, again, when we look at what the regulations state, that you're supposed to have a causal beneficial relationship between the cost pool and the base. Again, if we look at the fact that the fringe pool is made up of all fringe expenses for all employees, then the most logical thing would be that we would have all labor then as the base of the fringe pool. And then again, similar to the previous slide, and I'm just going to flip back for a moment, we talked about total labor dollars or total labor hours. Similar concept here. Again, it could be direct labor dollars or direct labor hours. Again, with the issue with the hours is just that fluctuations in hours can potentially cause greater swings in absorption and variance issues. All right, with overhead, there are actually a number of acceptable methods, and again, we'll kind of tackle these from the most common, and it's usually direct labor cost. So we look at, again, direct labor dollars, I guess would be a better way to say that. Most common, especially in a service or a high labor industry, right? So even if you're manufacturing something or reselling a product, if you've got a significant amount of labor, then labor seems to usually be the most common approach for the allocating overhead. Direct labor hours can be used. Again, you run the risk of proper, or I should say, of variances and the absorption. If you're going to do labor hours either for fringe or overhead, you need to make sure that you've got a really good way to estimate those hours and that estimate is as accurate as possible. The third method on the screen here are direct material costs. Again, this is useful in a situation where there's material costs, and I say significantly outweigh labor costs. And that could be something where you have a few people who are doing a lot of work with a lot of materials potentially, right? And so we've got a very high material cost in comparison to labor, so maybe it makes more sense to allocate overhead over the material costs. You could do total prime costs. And as a reminder, hopefully most of you know that prime costs are direct labor plus direct materials. This reflects a value-added aspect of the materials. In particular, we have a client where this really makes sense for them. The nature of what they do is assembly work. So even though they're a government contractor, they're buying a fair amount of commercial products. They configure and assemble them in such a way that meets a very specific need. They install their own software on it. And because they are opening all of that equipment when it comes in the door, they actually set it up in their environment, configure it, connect it, test it, make sure it works, repackages it, and sends it out to their client. With all of that hand touching of the material, it makes sense for us to allocate their overhead over both direct costs, over direct labor and direct materials in that situation, or prime costs as we call it here. The units of production method is helpful in a high volume production environment. Think about a situation where you've got machines that are able to spit out hundreds or thousands of widgets in an hour. And I can take costs because I know how many widgets I'm making or plan to make, right? And I can calculate that, my pool, identify those widgets, identify the costs associated with those widgets, and allocate it out that way. Similarly with machine hours, in a situation where I maybe have a highly automated or heavily machined environment. If you think about, a situation where something is on a lathe or some other type of machine for an extended period of time, but I can measure that time and I know the cost of operating that machinery can be very helpful. This method can be very helpful. All right, with G&A, again, general and administrative costs, we have two acceptable allocation methods. The first is total cost input, or TCI. It's the method that we'll talk about today when I go through some samples with everyone here. It is the most common, and you're allocating those G&A costs. You're allocating those costs over, and I should put like a little asterisk here, over most other costs. So even though we call it a total cost input, we're taking all the G&A costs and essentially allocating them over all of the other costs. So that would be direct, fringe, and overhead. There are some exceptions to that, particularly with unallowable costs. They get in there and cause some problems to the math. The second acceptable method here for G&A is value added. It is less common, and it is used in conjunction when somebody has a material and subcontract handling or an M&SH pool. which we'll discuss in the next webinar on advanced indirect rates. So if you'll again just kind of take that one and put it to the side, we'll talk about it the next time that we're together. The last pool that we talked about in the first section was unallowable. While again, we do collect these in a separate pool so that they are segregated. So it's important to note here, if you remember if you joined us for the first webinar in this series, we talked about segregating unallowable costs. We need to make sure that they're not included in our rates. The simple way that we do that is to create a separate pool and actually give them all a 9 series of accounts. But they don't get allocated, but some of them do, particularly any unallowable direct and unallowable overhead costs are included in the base of the G&A calculation. And the reason for that is because if the direct costs will otherwise be part of the G&A base, then the unallowable direct costs also become part of the G&A base. And part of the reason for that is really a bit of an additional penalty of sorts. Excuse me, it's not an extra cost, but it's kind of an extra penalty in that not only is the cost unallowable, but you're now forced to spread G&A over those unallowable costs. So now a portion of your G&A expenses are non-recoverable. You will not get those back in your billable rates. All right, with that, Liz, we'll kick off the second poll here, please.
Okay, which of the following is not an acceptable allocation method for overhead? And there were quite a few allocation methods that were acceptable that you had discussed.
Yeah.
So
yeah, we had 6 of them in there actually. Yeah.
Yeah. So let's see how the responses are coming in. We have about 60% of the audience has voted. Staff would like to know, what about having 2 pools for fringes, one for direct and overhead employees and another for G&A?
So the only reason that you would do that is that you would have to have completely separate fringe benefit packages. So it would have to be a situation where you actually had a group of employees who received a totally separate set of benefits that another group of employees did not receive. I won't say that it never happens, but I will say that it doesn't happen very often. And if you want to talk about that, that's really kind of an advanced thing, and we would need to chat about it offline.
Good deal. Well, thanks for the question, and thanks for the response too. Very good. We have the responses are in. We'll go ahead and close the poll, share those results. And we have a majority of the audience that responded W-2 employee labor.
That would be the correct answer.
All right, awesome.
All right, so let's now talk about the math of indirect rates. And this is, again, for me, is I guess where my nerd comes out, but this is kind of the fun part. The first part is really easy. If we think about pool and a base and calculating a rate, division is pretty simple and straightforward, right? I take my numerator, which is the pool, I divide it by my base, which is the denominator. I come out with a percentage, and that is my rate that I applied. Seems pretty simple and straightforward. One of the comments, or I should say one of the questions that we get on a regular basis is someone will say, are my rates too high or too low? And what I have to tell people is that rates are in and of themselves, they're not inherently high or low. The rate is the rate, right? I'm going to take your pool, I'm going to divide it by your base, and it's going to come out to the number. Now, relatively speaking to another contractor, is your rate higher or lower than somebody else's? Yes. Does that mean that your rate is good or their rate is bad or vice versa? Not necessarily. We really have to make sure what we focus on is the correct composition of the pools, right? So that we actually have excluded unallowable costs, that in the case of fringe, that we have homogeneous pools and homogeneous accounts. That was one of the things that we talked about in the first webinar, and to lay the foundation was making sure that we have homogeneous accounts and homogeneous pools, and that simply means that we only have like expenses within that account or like expenses within that cost pool, that we've excluded the unallowable costs, and then that we are using a proper allocation method. And again, making sure that the base, in the case of fringe, right, if we're saying that we're going to allocate fringe over all direct labor, one, we need to make sure that we have, if we allocate fringe over all W-2 labor, we need to make sure we actually have all of the labor in there. And we also need to make sure that we don't have something besides labor in there, right? So we can't have any non-labor expenses in the base. But once we've clarified that, you simply do your division right, and then the rate is the rate. And the math there is pretty straightforward. What I do want to walk you through here, and so what I build is a dummy setup here with some sample data in it. But you'll see on the screen here that I've got the 5 cost pools that we've talked about today. So you'll see direct, fringe, overhead, G&A, and unallowable. As I advance through the slides, just so you're prepared for what's coming, my little red box is going to move around as we talk. The color coding is going to move, and I've got it there to kind of show where the information is coming from. So we're going to talk about fringe, and we've said that the base of fringe usually, and again, my approach today was to take what we typically do, and that is labor dollars and all labor dollars. So you'll notice that I pulled my direct labor over, and if you follow the color coding there, you'll see that my overhead labor comes down to $20,000. My G&A labor comes over as $30,000. And then my 2 unallowable labors there, I had some unallowable direct labor and unallowable overhead labor. And I'm going to give you a hint, hint, wink, wink, nod, nod. Remember that. We're going to talk about that in a moment. But both of those combined and came over. That was my base. And I did my math, and so now my fringe rate here is 26.61%. My next pool for the math is going to be overhead. So I've got my overhead expenses up above. Important thing to note here, and actually I see that I should have added another green bar. So if you look at the top portion in the pool, my idle time or my overhead labor is $20,000. Notice that I have applied fringe underneath of that at $53.23. If you were to get out your calculators right now and take $20,000 and multiply by 26.61%, you would come up with $5,323. And so the reason that we do that is that we need to remember we talked about allocating fringe. Well, if I've got overhead labor in my overhead pool, then it needs to bear its portion of the fringe. So that's why I have an applied fringe, and that calculation, comes in over there. My base here that you will see of overhead, again, the typical approach that we have is direct labor dollars. And then you're going to see unallowable direct labor. Remember my hint, hint, wink, wink? Okay, well, this is it. Remember I said that when we talk about allocating the base, in the situation here, the base is direct labor. And since I have unallowable direct labor, then I have to include my overhead in that. So now what's going to happen is I'm actually going to end up with a portion of my overhead that's going to be unrecovered, because I'm allocating my base over some unallowable costs that I can't bill the government. So now not only are the unallowable costs not recoverable, but the portion of overhead associated with them are also not recoverable. This is really key in calculating rates. And I will say this is one of the areas that a lot of companies get it wrong. And auditors know this, and this is kind of a low-hanging fruit in an audit when we're talking about rates, because they know. And I didn't get into bid and proposal on IRAD costs. Again, something we can talk about in the next webinar on advanced indirect rates, because they throw another wrinkle into the mathematical calculations here. But this is an area that we have to make sure that we get those unallowable costs into the proper bases, because they do affect the rates. And you can probably imagine that if I took $89.99 out of the base, that it wouldn't make a significant impact on the overhead rate, but it does affect it, and an auditor will find that, and an auditor will certainly correct that when they are calculating your rates. You also notice that we have the applied fringe in the base, because remember when we said that we had fringe was allocated to direct labor. Well, now that I've got direct labor in my base, I also need to bring over the associated portion or the applied portion of the fringe with it. So again, now that you understand the composition of the pool and the base here, do my math. And with the math, I come out to my new overhead rate of 34.45%. Same methodology with G&A, though it gets a little more complicated. You'll see that the base of G&A has several lines and lots of colors. Take a look in the pool up above. You see that I have my G&A labor of $30,000. I know it's all the same, but just for visual, if I go back to my fringe, remember I had G&A labor of $30,000. So now that I come over to my G&A pool, I'm going to have my applied fringe, just like I had applied fringe in overhead. I have my other G&A expenses. Remember some of the things we talked about, like accounting, business development, HR, and IT kind of expenses. So I now have my total G&A pool. The base of G&A, remember I said the approach that we were taking in today's seminar is that TCI, or total cost input. And while the terminology is total cost, I always like to clarify that it's over most other costs, because there are some situations where we have to make adjustments to that. If you take a look here, you'll see that my total direct costs come over. Again, if you can follow all of my color coding, my total direct costs come over. My applied fringe on direct labor has to come over because, again, I've got, as part of my total direct cost, I have direct labor, so I have to bring the applied fringe on that. I have to have applied overhead on direct labor. Remember, if I go back and look at overhead, I said that I'm allocating overhead on direct labor. So if my base of G&A has direct labor in it, then I have to have applied overhead that lines up with it as well. And oh, look what happened. See, this is fun. I had unallowable direct labor as my base of overhead, so we had to pull, so we had unallowable direct labor, so I had to bring that into my base of my overhead. I also have to do the same thing in my base of the G&A. I have to pull that unallowable portion in there. I applied fringe, and then we get into my unallowable overhead, because remember, my overhead expenses are part of the G&A pool. So any unallowable overhead expenses are part of the G&A pool. And I realize there's a lot of information that we're covering here. I'm actually going to go back in a moment and do a quick review of these numbers again to make sure that we're all on the same page. But I confirm that now all of my costs are correct in the base of G&A, and I've got my G&A rate. And there is no allocation of unallowable. Remember when we talked about a couple of slides back, we don't allocate those out separately, but we do identify them and segregate them. That said, let me show you here. Remember I said that some expenses are not included in the base of G&A. Even though we call it a total cost input, I said it's over most expenses. Well, charitable contributions are typically a G&A expense. And since they're unallowable, they would not be in the G&A pool. And because they are otherwise an unallowable G&A expense, then they cannot be in the G&A base, right? So that becomes something that lives over here in this other pool and doesn't get part of any other calculation. Again, I'm going to back up, just do a quick review here. Fringe. The example here is that we allocated over all labor, and you can see that we've pulled in direct labor, overhead labor, G&A labor, and unallowable labor in order to calculate, because again, that is still our employee labor. Notice, I don't know that I pointed this out before, notice that my base of fringe does not include subcontractors, because remember that I said subcontractors, those expenses are paid by somebody else, those fringe expenses are paid by somebody else. For overhead, we said that the typical approach for many companies, and certainly many of our clients who are service providers, the base of overhead is typically direct labor dollars So you'll see my direct labor down there. Because I have unallowable direct labor, I have to bring it over. And because my fringe is allocated over direct labor and unallowable direct labor, then I have to pull those dollars over as well. And when we talk about G&A, again, typically the total cost input here. So you'll see that things like total direct cost, applied fringe, applied overhead, and then that unallowable direct and unallowable overhead expenses would come over here because they become part of the G&A base. With that, I'm actually pretty excited to announce here today, you guys have access to a brand new tool that we've launched on our website. It is an online indirect rate calculator tool. You can access it a couple of ways. If you go to leftbrainpro.com, in the menu bar at the top, you'll see tools, and you can click on that and get to the indirect rate calculator. We've given you the direct link here, again, leftbrainpro.com/indirect, and notice there are hyphens, so it's indirect-rate-calculator. Everything is in the browser, set up. It looks a little different, but the basic format is what you see here, what we've walked through. You'll enter total dollars from your trial balance into the appropriate field. It calculates as you go along. When you get to the bottom, you can enter your email address and it will send you a copy via PDF. So you'll have a copy for your own records. You can come back and use it as many times as you like. And one of the other things that we also just launched on the website is on the same page. You can download an Excel file version that you can play with on your computer at home or at work. All right, with that, Liz,
That's awesome.
another polling question, please. Thank you.
Yes, okay, so this third polling question is the review question. Fringe is typically allocated over. I think that one of these answers might be a trick answer, so hopefully you're all paying attention. While you're responding to the poll, I did drop the link to Left Brain Pro's new indirect rate calculator in the chat box. So if you were following along and you just want to click right through to get to that calculator, you can go ahead to the chat box and click through it. So that is really awesome. How long did it take to develop that calculator?
Great question. So the calculator itself has been a work in progress, made some tweaks to it, and then we actually found a tool that you can use to convert them to convert almost any Excel file to HTML and use it on the website. So it's another one of those geeky fun things to play around with.
Yeah, definitely. Well, that sounds like a really great resource. Well, thanks everyone for responding. So we're going to go ahead and close the poll down. We'll take a look at the results, and it doesn't look like too many of us got caught up with the trick answer, but we are still kind of spread across the board. So can you recap for us?
Yeah, so again, and probably a couple of things here. The word typically is kind of key. Again, I said that typically fringe is allocated over all W-2 labor. I did put a trick answer in there, said all labor, but I even hinted at you, including temporary and contractors. And remember, we made clear that we would never allocate fringe over temporary employees and subcontractors. So that would have been a clue. I would say that direct labor would not have been a terribly incorrect answer, because again, there are some industries, particularly the A&E, where they do allocate over direct labor only. And then D, so this is one of those, I think, we've all had one of those instructors in high school or college, like the best answer. Like some of these could be answers, but the best answer really is W-2 labor. Again, I tried to trick you a little bit with direct and indirect labor, kind of applying that, well, maybe you have some temporary labor or other stuff in there. Again, the key is always going to be that W-2 employee labor.
Sometimes that's the best way to learn.
All right, so let's talk for a moment about full cost recovery. And if you've got questions, we've had some great questions so far. Please drop those questions in the Q&A, because we're coming up to that time point. So I want to talk about full cost recovery here, because when we're talking about government contractors and we're talking about this whole concept of indirect rates and calculating it, right? If I said, what's the primary purpose of being in business? Hopefully you would answer to make money, right? Well, how do we make money? We need to know how much something costs. And I don't want to get too far down the philosophy rabbit hole of how we price stuff, whether we look at a cost roll up or whether we look at market prices and what the market will bear. The reality is it's both, right? I mean, you have to look at, okay, if the product that I'm building costs me $75 to build, I mean, my pure cost, no profit, is $75 for me to make this product, but the market will only bear $80. No matter, I mean, I can try to charge $85, but I'm not going to sell. Maybe I won't sell any, or I certainly won't sell as many when everybody else is selling them at $80, right? Then I know my profit margin there is going to be $5. So I need to be aware of both of those. And our focus with a lot of clients really is making sure they, I should say with a lot of clients, our focus with all clients is always about making sure that they have total cost recovery. It's probably even more imperative in government contracts because you have a lot of government contractors who are performing on cost type contracts, meaning that they get to bill their allowable costs plus either a fixed fee or an award fee. There are just some different structures out there. That could be an entirely different webinar that we could do. But suffice to say, they're doing cost type contracts. So hopefully you're picking up that it's really imperative they understand all of those indirect costs. They've got the right costs. They've got the composition of the pools correct. They've got the allocation methods correct. They've done the math correctly, right? Because you can see that if you get something wrong in your calculation of costs, then what's going to happen? Rarely does somebody miscalculate in their own favor. Usually they're miscalculating and it's hurting them and it's cutting into their profit margins. And in fact, one of the common calls that we get from new and even existing clients is, hey, we're doing work on this contract or we're doing work on these multiple contracts, but there just doesn't seem to be as much money left at the end of the month. And when we get in there and start digging around, we realize that there are problems in their indirect rate structure. So it's really about making sure you understand those costs so that you can bill them and recover all of them. And so with that, so what do? You've got to review the rates, right? So you build a budget up front, you calculate what your indirect rates are going to be going forward based on that budget. Those become your interim billing rates that you use. And then you got to track, right? If you said, this is what I'm going to bill my clients, then you want to track that and make sure that your actual to budget makes sense, and that you're reviewing budget and you're reviewing any variances. And you've got to do that monthly. You've got to stay on top of that because 2 or 3 months in, something can take a hard left turn and really cause a problem, and you got to stay on top of it. Our second bit of advice is that, you need to adjust the budget accordingly. And it might be minor adjustments. It could be, readjusting stuff within a pool, realigning, some cost items, some line items. If it's a situation where we need to realign costs between pools or among pools, that becomes a little more complicated. But we need to make sure that we're doing something to adjust. Again, we don't want to be in a situation where we get to the end of the year that we have significantly underbilled or overbilled the government based upon this interim billing rate. So we've got to be able to, and that adjusting may also mean that I have to just adjust spending, right? So maybe I say I got to back off some spending, or we've had some clients in a situation where they've actually had to kind of put the foot on the gas to spend more money. They were being a little too conservative and realizing, hey, we've actually got a little more money in our budget that we can be spending. So some of those things that we wanted to do that we held off, now we actually have the cash and it's within our budgeted rates. We need to go ahead and do those. I hinted at a moment about monitoring over and under billing. One of the topics in this webinar series, actually the last one, will be about completing the incurred cost proposal. And that's the annual reconciliation of all the costs that you've incurred in comparison to all the costs that you billed your government clients. And you need to figure out whether you've over or underbilled the government and how you're going to reconcile that. But you don't want to wait till the end of the year again to see where that is. You've got to be looking at this on a monthly, quarterly basis, tracking those rates and what you're billing, because you still have time throughout the year to make updates. And that takes me to number 4, and that is you definitely need to be updating your billing rates every year, right? So you should be creating a new budget with new billing rates that are going to be your new interim billing rates for the following year. Don't just build a budget once and calculate some rates and keep using that going forward, right? That's going to get you in trouble. We see a lot of clients who take last year's actual rates and use that for this year's billing rates. Not a completely horrible process, but not the best either, right? Because you're assuming that whatever you did last year in that situation, you're assuming that whatever you did last year is going to be the same thing that happens this year. And that's not always true either, right? So that can get you into trouble. But the last couple of bullet points here, it's really important that you might need to make mid-year billing rate changes on your contracts. And that can happen when there's a significant change in the budget. Oftentimes that comes in the case of either a new or a lost contract, right? So you build your budget thinking, and again, we have one of the topics in the webinar series coming up is about budgets, and we'll get into some details about that. But right, you build your budget thinking, this is the amount of work I think I'm going to do. But what happens if you win a really big contract or lose a big contract, or you don't win a big contract that you think you're going to win, right? You build your budget saying, hey, we're really confident we're going to win that $5 million contract, and maybe the year comes around and you don't win it. Or maybe the award gets pushed, right? The government doesn't always award when we think we're going to. So maybe we even end up winning it, but maybe we end up winning it the following fiscal year. Well, that messes up this year's fiscal rates, right? So we've got to look at those kinds of things and be able to make the appropriate adjustments along the way. Again, whether it's adjusting our spending habits or potentially even adjusting our billing and proposal rates. So in conclusion here, higher margins and improved profitability, we have found are the direct result of proper allocation of indirect rates. As I said before, that if you don't understand your costs and you're not calculating those correctly, probably 99 times out of 100, it is not in your favor and you're eating into your profit margin. So make sure that you understand, calculate all those correctly, and maximize your recovery of all costs that you have incurred. With that, Liz, I'll let you kick off the last poll for us, and then we can head into some Q&A.
Oh, there we go. That poll's up on your screen. How accurate are your indirect rates? And there's not really a wrong answer here. So we'll go ahead and leave this up there. Looks like we have about 2/3 of you who say good, and then about 1/3 who the calculation of indirect rates is new. A couple of you say perfect, and then on the flip side, we have a few folks who are raising their hands saying, yes, we are losing money. And what a great call to action that having accurate indirect rates can help to improve profitability significantly.
Well, hopefully you guys pick up on the, hopefully you guys pick up on a couple of hints there. Go back and use our indirect calculator on the website to help you calculate your rates. But certainly give us a call. I mean, any category that you're in, but if you're in C or D and saying we're losing money or we've never calculated your indirect rates, give us a call so we can help you through that process.
Absolutely. We'll go ahead and leave this poll up for about 5 or 10 more seconds, but while we get ready to close it down, we have a few questions coming in. So let's take a couple questions. So from Tessa, she's wondering if you can just remind the audience what is considered most commonly unallowable direct labor.
So unallowable direct labor can occur, and probably a better terminology is sometimes unbillable direct labor as well. So that can be a situation where you incur labor outside the period of performance, and that's a common issue with a lot of contractors. So if you have a period of performance on the contract and you do work either before or after that period of performance, it's not billable. You can't reclassify it somewhere else and try to recapture it. It's it's really an unbillable, it's an unallowable direct labor. It was direct labor in its very nature, and it still remains direct. Another example is on if you have a contract that has specified labor categories and you have an employee work on that contract who either doesn't meet any of the labor categories or you've billed them in an incorrect labor category, that difference becomes unallowable or unbillable because, again, you're outside the terms of your contract.
Thanks for taking that question. We have another one. Should we take that now or should we take that
Sure.
in a moment?
Yeah.
Okay, awesome. From Charles. Charles is asking about provisional rates. He says, what about when provisional rates are provided from government based upon the incurred cost report?
Yeah, so again, that's kind of a common situation. It's not inappropriate to use those. It's just unfortunate to remember when you're submitting your incurred cost proposal, that's based on historical data. By the time you've submitted it, several months have passed. By the time the government has likely reviewed and approved it, more time has passed. And so now you're using historical data that is several months old to project billing rates into the future. And you're just perpetuating a situation where there's a big gap between what you are proposing, right, these provisional billing rates, and what you're actually incurring. And that's why one of the hardest things, I would say a significant number of our clients do not do budgets, and it's very unfortunate. It's one of the things that we encourage them to do. We've built some templates. I hope that if you're interested in budgets or even curious about it, you'll come back and join us on a future webinar. We'll be able to share a template and a tool with you for that. But that's why it's really important to look to the future and say, this is the work we have coming. These are expenses that we expect to incur. These are the rates that we have looking forward, and we're going to use those bidding and billing the work going forward. And it's much more likely that those rates are aligned with what comes out than if you try to use some historical number.
That's really helpful. Thank you. All right. So we have about 1 more minute for questions. Go ahead. Do you want to bring us, as we kind of come toward close, let us know how we can connect with you.
Yeah. So on our screen here, if you go to our website, leftbrainpro.com/presentations, or if you just go to leftbrainpro.com, you'll see in the menu up there, again, the tools. You can access the indirect rate calculator. You can click on presentations. When you go to the presentations, select today's title from Incorsa. When you go in there, you'll be able to download the presentation. There'll also be some links to resources for you. Just like Liz, you can find us on LinkedIn, Twitter, and on Facebook. Please contact us at support@leftbrainpro.com if you've got any questions. Again, support@leftbrainpro.com is the best way to reach us. And then the next 2 webinars in this series with Incorsa are the Advanced Indirect Rates on March 17th. And then we'll talk about developing your first cost and price proposal in April.
Excellent. So we do have a question that came in as a follow-up to Charles. Question. This is from Lavetta, and she's wondering if the provisional rate is lower than insurance recaptured.
Yeah, so great question. Try to answer that in the minute or so that we've got left here. Again, the issue where you're billing at a provisional rate, you calculate your actual rates at the end of the year, and you're going to be in a situation that you've either underbilled or overbilled the government. If you've overbilled the government, you need to open up your checkbook and write them a check, right? Because you've overbilled them, so they've paid you more than what your actual costs are. And if you've underbilled the government, technically you have the ability to go back now and ask for more money once they have approved those rates. However, the problem is kind of twofold. One, usually when Congress is allocating money up front, and when the various budget managers are doing those allocations throughout the fiscal year, they're not leaving any money on the table. They're spending what they have. So oftentimes there's not any money left to go after. The other real problem is that, again, by the time you've submitted your incurred cost proposal and received your final indirect rates, that can be months, sometimes years later, and going back to a program and saying, hey, now I want to bill you additional money that's now due to me. Oftentimes the money just doesn't exist. So that's what, again, another reason why it's very, very important to manage those rates so that nobody ever hits the target dead on, but you want to make sure that you're just not in a situation where you've either significantly underbilled or significantly overbilled the government.
I think that's a really good question to end on, and a really good segue to your program next month on advanced indirect rates.
Yep. So if you come back next month, we're actually going to talk about how we, somebody asked earlier about splitting fringe pools, splitting overhead pools. So we'll talk about that, intermediate pools like facilities and IT. So we're just going to take this and expand upon it and make the math even more interesting.
Sounds great. Well, with that, we want to thank everyone for joining today. Thanks, Robert, for a great presentation. You'll be able to take a course survey following the conclusion of the program when you close GoToWebinar, so we'd love your feedback. You can log into your Incourse user account to access your CPE certificate after the program ends, and then also you'll have access to the recording and the materials from Robert later on this afternoon. Robert will be back on March 17th, so we hope you can join us. Go ahead and check out Incourse.com for other upcoming programs, and we look forward to having you all back with us again soon. Take care.